Barry, you know, Scott, he's a frequent guest. He's a personal friend of mine. He's made some big calls. Some have been right, some not as much. What's your knock on the Maynard call?
Well, I would say that the biggest issue that I broadly have, and I didn't listen to the interview with Scott yesterday. I worked at the same firm as he did for some time, but we used to joke at Lehman Brothers that bond guys are always negative because the best they can ever get is par. So I'll exempt my old colleague Rick Reeder from that, but otherwise we always used to chuckle about that. Broadly speaking, though, my view here is that what happened in the first half of the year was not the market discounting serious deceleration in economic activity. It was not discounting a recession. It was, in essence, the mother of all taper tantrums. And this was what we expected to happen in the first half of the year, was a large correction as monetary policy turned around, fiscal policy turned around to a lesser extent, and we were going to have a Fed policy-related correction. So when we hit the two twins in late June, that was twin Fed hawkishness, market expectations of policy tightening, and we hit peak inflation. Yep. That was really the inflection point. Now, what happened over the last couple of weeks was also something that we expected going into QT, into reaching the maximum caps. If you consider the three channels for QE and QT, which is liquidity, that we felt was fully priced. The actions of the Treasury early in the year drained a lot of liquidity out of the system. The portfolio balance channel, which is the Fed forcing investors into riskier assets, that's what the taper tantrum was all about. So those two pieces were adequately priced. What wasn't adequately priced was the level of 5- and 10-year real or non-inflationary interest rates. We've just had a shock in that part of the curve. 10-year real rates after the July meeting were at about 7 or 8 basis points. They're now at almost 90 basis points. So that real rate shock, and by the way, that's what triggered the corrections in 18. That's why we just had an aftershock to what we call the mother of all taper tantrums. It's likely complete. Now, I wouldn't totally.
Barry, let me jump in on it for a second, though. Do you think so? Sure. The stock market is not going to fall 20% from here, I think what you're saying.
I think that's highly unlikely that it would do so. Now, there is a scenario where it could happen, which would be the currency declines that we've seen in dollar yen and Chinese yuan get really unruly were the Fed to push too hard. But I think that's a low probability outcome. So I'm not totally dismissive of Scott's scenario. And downside puts are cheap. So if you want to buy some portfolio insurance, that makes sense. If I'm right and we go back to 4,800, you won't mind having spent that premium on those downside puts. But I think Scott's, what sounds to me like his base case would be only a tail risk for me.
Okay. What is the risk of a significant policy mistake by the Fed, which, let's be clear, is slamming on the brakes? They've been going 100 miles an hour for a long time. They're not trying to slow down. They're trying to stop the car now.
Well, I think the Fed was trying to do two things over the since the July meeting, which they largely accomplished. They were trying to talk the market out of 2023 rate cuts. And, I was suggesting fading those as well, because I think it's unlikely. And they were trying to talk up those rates in the 5 to 10 year part of the curve. And as I described, they did that. So I think the Fed's been largely successful. My concern is that they push too hard and they send those energy dependent currencies, euro, pound, yen, and RMB, into a free fall. So that's really where the Fed risk resides. And externally and then domestically, it's in the housing market. As you know, we've had this tremendous decline in demand for housing and the supply for housing. So those are the two areas of risk. Lael Brainerd noted those on Wednesday. And I think that was really what kicked off the market stabilizing, was her recognizing, these are two areas of vulnerability. And if we push too hard, bad things could happen.
Well, I love the fact that you ended on housing, because that's where we're going to start our next conversation. Barry Knapp, Ironside's Macro. Barry, it's good skiing where you are there now. I don't know if it's 100 degrees. You're like Gavin Newsom in a fleece. It's like 110 degrees. Barry Knapp, thank you very much.
Still golf season here, Brian.
Still golf season. We got the slopes behind it. I love it. All right.